Hello everybody, welcome, welcome, welcome. Happy New Year, if I'm still allowed to say that. But it is of course the first PQT of 2025. Delighted to be here again. As you can see, I am coming to you as host today from a hotel room, so if my signal disappears at any point, bear with us because the experts of what this show is all about, and we've got three absolute industry heavyweights with us on today's payroll question time. And of course, there's some breaking news as well this week. So if you haven't seen the news that has been launched, we will be discussing that during the course of today's show. We're also going to be talking about some subjects which I know are always hot topics on PQT. One of those is talking about payrolling benefits in kind. So if you have any particular questions around that subject area, now is the time to get those thought caps on. Now is the time to start putting them in my questions box. So when we get to that section, I can ask our wonderful panel here their thoughts so we can get their expert responses as well. We're also going to be talking about holiday pension reforms, other hot topics, the latest news from the SD Worx Academy and more. But before we get there, let me run through a little bit of housekeeping for today for those new to PQT. So we have, of course, got some pre-advanced questions that I will be asking our panel today. However, we want your input as well. So whatever your question might be about payroll, even if it's not related to today's topics, please do put it in the questions box. This is your show. So anything that's really troubling you, any challenges you have, if we think our panel can help you, put it in the questions box. We'll ask those in real time. We will also be running two polls today. So that's your opportunity to get involved. So when we ask you those questions on those polls, please do click the response that most highly relates to your payroll department, and we will obviously share those results and we'll talk about them as well with our panel. We are, of course, recording this session, so you don't need to be scribbling lots and lots of notes. We will send you the slides after the recording session has finished, and there will also be a survey. Now, that survey is super important. That's your opportunity as an audience to tell us what you want us to talk about in a future PQT episode. So there's a burning subject area that we haven't tackled yet, or maybe you want us to re-tackle something we've discussed before. That's your opportunity to let us know. And lastly, but by no means least, I'm going to read a little legal disclaimer for you all. It just says the presentation does not provide definitive answers to individual queries, and in some places takes views on matters which are uncertain. It is not intended to be relied upon in any specific context or as a substitute for seeking advice, legal or otherwise, on a specific circumstance, as each case may be different. Now, lovely to see the first question already pop into the box. Thank you, Marcel. I will get to that very, very shortly. Please keep them coming through. For those not familiar with myself, my name is Nick Day. I host PQT. Wonderful to be here. I've been in the payroll industry now for over 2 decades. I host the Payroll podcast where you can get an audio version of this show as well. We'll release that at a later date. I also run JGA Recruitment, which is a global payroll specialist recruitment firm. And yeah, delighted to be here, but that's enough for me. Let's introduce to the wonderful panel. And moving from my right to left, Simon Parsons. Can you introduce yourself, please?
Yeah, good afternoon, everyone. It's good to be with you again. Simon Parsons, Director of UK Compliance Strategies at SD Worx in the UK, entering into quite significant, I think it's 28th year here on the 3rd sentence. So I've worked for the business a number of times, and Fellow of the Chartered Institute of Payroll Professionals. It's good to have Mathew here from the CIPP. I have the Master of Science in Payroll Management, Chair Irene, and the BCS Payroll Specialist Group.
Very, very specialist hands indeed. Moving, of course, from right to left, Richard George, my good friend. How are you doing?
Yeah, hi everybody. Hope you're all very well. Richard George, Director of Education for the Payroll Centre. Sadly, 39 years in payroll, or not sadly, happily 39 years in payroll. Similar to Simon, still a number of consultation groups for more than 300. All the good stuff like that. So looking forward to today.
Fantastic. And of course, last but no means least, the very articulate and wonderful Mathew Akrigg from the CIPP.
Thank you very much, Nick. Yeah, I'm a Policy and Research Officer at the CIPP, part of the policy team responsible for making sure that all payroll professionals are kept up to date with everything going on in the payroll world, as well as trying to fight on your behalf with the government for the things that matter to you and impact your day-to-day work.
Fantastic. Now, I had a sense that there might be a few questions coming in with today's topics, and I'm delighted to see we've had not 1 but 3 questions come in. Please keep them coming. We're going to get through every single one of those questions in just a moment. Of course, they're going to relate to our first part of today's conversation, but let's find out what our topics are. So the first part today, of course, payrolling benefits in kind, employment allowances, statutory sick pay. We're going to be talking about holiday pay, pension reforms, hot topics. There's going to be a Q&A. We're going to talk about the SD Works Academy and a whole lot more, as well as that latest news element that I mentioned just a moment ago. And we will go to that latest news relatively quickly, but before we do, because I want to get through these questions, there's now 4 in the box, which is wonderful. Let's start the show then with payrolling benefits in kind. Before we get to those questions, Simon, I wonder if you can give us a bit of an overview.
Yeah, sure. So the government have confirmed at the autumn budget that mandation of payrolling will go ahead. There is going to be a March fiscal event, so I guess we'll hear a little bit more of what that means and how that's being implemented in some aspects. So what does that mean? At the moment, on the current announcements, that every employer in the UK that provides benefits to employees will have to payroll them. So they'll have to have data values captured in payroll, with the exception of 2 items currently, which is loans and accommodation, because they're usually a retrospective calculation. So it's very difficult to predict what they really are. But even with those, there is going to be a mechanism of prediction and correction. Of course, that brings in some obligations. Many people have been payrolling since formal payrolling came in April 2016 already. And of course, we've had other legislation which overlaid with it, with the introduction of OPRA rules in 2017. Optional remuneration arrangements, salary sacrifice would fall under that, flexible benefit schemes, etc., or a choice of car or cash would also fall under OPRA rules that all impact that. So there is an element of getting ready. If anybody is wanting to go early, and to a certain extent, personally, I'd encourage that, go early. You have to register for April 2025. For April 2026, at the moment, on the basis of things, if it goes away as announced, goes forward as announced, you don't have to register because everyone will be automatically registered because you'll be obliged to do it that way. But for the current year, if you're wanting to start in April 25, you need to plan and register, get your software ready, get your supplier ready. Are there any additional costs or project work that needs to be done? Do your third parties need to get ready as well? Because I'm going to say most of them aren't really geared up for payrolling very well yet. And consider who's doing what, where, why, and how. Does that do for a starter?
It does, it does. I like the bullet point as well regarding the accurate data. For anyone that's going through any kind of transformation or whatever you want to do in your department, it always starts with accurate data. It's a really good element there to avoid that misinformation. And of course, it'll support other initiatives you might be going through as well. But I've got 5 questions in the box. I'm going to run through those in just a moment. Anything you'd like to add to that? Either, let's start with you, Richard. Anything that perhaps you wanted to?
Yeah, I think, obviously being prepared yourself and having a prepared payroll is very key. But then the other aspect of it, putting my learning head on, is going to be communication. You have a lot of staff who've had a possible process through the legacy P11D, where the effect on them is an amendment to their tax code, hopefully pretty proactively in relation to how the coding has been set up to take account of the benefits. But obviously this is going to be a big shift change for them. Firstly, in respect of the real-time scenario of the tax liability, especially in that first year of the benefit being received. So if you think about it today, if you give a benefit in a tax year, HMRC aren't even going to know about it till July after that tax year is finished, which therefore makes it retrospective for realistically possibly up to 3-4 months. So there could be a crossover, there could be a period of double taxation, depending on the scenario, which you're going to have to support and be very considerate about. But I think one of the other aspects that's coming out now is also the whole issue of Class 1A. So again, it's a retrospective charge. Once we go mandatory in 2026, it'll become a real-time charge. And yes, you were going to pay it anyway as an employer, but one of the key statements that keeps coming out is cash flow. You keep that cash for the year and have to pay it in July. Well, now that's gone. So there's that reforecasting of revenue, reforecasting of charge, and obviously everything that Simon says about the actual process itself.
Super. And from your perspective, Matthew, before I dive into our audience questions, what are the most popular or most common questions that you may have on the CIPP desk in relation to parenting benefits in kind? Maybe something that, if you're getting a regular question, I'm sure there's similar questions our audience will be considering as well.
Yeah, so kind of touching on a few points that have already been mentioned. I agree, Simon, that if you have the facility, you should probably be preparing to do this early before you're pushed. But in some of the surveys that we've run, there's a real split between people who are prepared to do things before they're pushed and people who are just waiting to be pushed overboard and forced into it. I think the questions that we're getting, like Richard said, very much around that messaging, and we've had conversations with HMRC and said you need a clear message around the overlapping taxation. We've been really trying to stay away from the term double taxation, because it is not double tax on a single thing. It is tax from 2 tax years overlapping with each other. And I think that is a real big concern from employers, because they know that they're going to get some pushback on that from their employees when it happens, because no one is ever happy about having more tax taken from them than they thought they were going to have. So really firming up how you're going to transition into it with your employees is going to be very important.
Okay,
Yeah, we're hearing
super.
a lot. So I was going to say, Nick, we're hearing a lot from people about, almost possibly having to consider bridging loans, because there are 2 real problems. Number one is obviously you're going to be taking more tax from them, but we also then have the issue with the 50% tax limit, which becomes a critical element. You can only take 50% of somebody's paying tax, and if they're already a 40% taxpayer, if you're, and a horrible phrase, but double dipping with the taxation on benefits that weren't being payrolled, there is a very high chance that you're going to go over it. So yeah,
I can see both Simon and Matthew nodding alongside you. Well, look, I'm
Yeah.
not going to lie. I think this is the most questions I've had come in on an opening subject matter on a PQT. We've got about 20 to get through, team. So I'm going to start from the top. I think some of these we may find we may have already answered as we go through them. A couple of repeat questions in here as well. However, starting with Mazel, who very kindly put the first question before it even finished the introduction. So thank you. We love that. Here it is. And it's a good question. It relates to me and you, Simon. We both have electric vehicles. Here we go. We have charges for cars outside our premises. If we allow employees to charge for free, do I need to BIC that to the payroll? Simon, I will come to you for this one because you have an electric vehicle, and I'm sure you have a thought.
Yes, so it's quite an easy answer at the moment, and the answer is no, you don't. However, will that change over time? We'll have to see. But currently, in relation to company cars or provision of vehicles or things like that, electricity is not counted as a fuel. Seems strange, doesn't it? Because that's how our cars are powered to a certain extent, Nick. But there's electricity is not considered fuel in relation to cars presently, and for the foreseeable future, as far as we're aware, there's no intention to change that. So is there a benefit in kind to report for providing an EV charging point and electricity to a vehicle? I think the answer at the moment is no.
Fantastic. Okay, into question 2. Now, this is a slightly bigger question, but we have emphasised that preparation is key. So Jackie has asked, what's the best way to set up BIC in payroll? I want to start doing this from April this year. It'd be good to get a little handout or a very quick, brief overview of the key steps that I need to undertake to get through this. Now, I appreciate this is quite a big question. However, if there is a sort of a 5-step strategy that one of you could recommend, just to give Jackie a bit of a head start, that would be wonderful. Maybe I'll come to you, Matthew, if that's okay.
Yeah, no problem. I mean, the very first step is that you need to register. So if you're wanting to payroll benefits from April 25, you need to go on HMRC's website. You need to go through the online portal and register. When you do that, it will give you a list of different benefits that you want to register to provide. So you need to choose from there which benefits you currently offer and which you want to payroll, and that will give you a little bit of an idea of what sort of things you need to consider and what sort of things you need to think about. After that, as we briefly alluded to earlier, you need to make sure, or it's on the screen here, that you need to make sure you've got accurate data to be able to input into your systems. On top of that, you need to make sure that your current system has the facility to do that. So I think the first step after registering, or even in the same step, would be to approach your software provider and have a conversation with them as to what's possible within the systems, what data you need. And usually your software provider will be able to talk through things with you and help you through that process themselves, because every software might have a different way of doing things. So I think that's the primary first couple of things that you need to do.
Perfect. You did very well to do that all with a straight face while Richard next to you was getting attacked by his dog. So okay there, Richard. Very good response indeed. I had a question. Now, of course, we'd usually have Andy Nicol with us, who is our kind of payroll pensions expert, but I'm sure our expert panel here can support us with the next question. There's been a lot of talk about pension relief of 40% for the higher earners. I know we're not doing this at source, so what do you suggest?
Okay, do you want me to jump in there?
Yeah, jump in.
So there is, well, even for the additional earners that pay 45%, there is a potential tax relief claim. But this only really affects relief at source arrangements, not net pay arrangement, because net pay arrangement gives relief at the prevailing rate of taxation for the individual. And salary sacrifice schemes do the same no matter what the taxation arrangement is for a scheme. It'll actually give it at the highest prevailing rate. But if you're in a relief at source scheme, the pension company claim a 25% top up of any amounts it receives as an employee contribution. The basis of that 25% is that's representative of the 20% tax, because they've only received 80% of the money, as it were. So they'll assume that there's another 25% to recover, making up to the 100%, giving tax. Of course, that doesn't take account of higher rate or additional rate. So on your annual self-assessment form, you can declare what values were paid to a relief at source pension scheme, and the kind HMRC, if you want to put that label on them, will pay you back the difference. And that would apply even for Scotland, where you've got different rates of 19, 20, 21, 47, 42. It'll pay you the differences between what was 20%. Of course, if you're a standard basic rate taxpayer, you won't get anything because that's already been paid. If you don't pay any tax, the thing about relief at source, which seems strange, is you get 20% or the 25% top up regardless, as if you had paid it. It's just assumed everyone's paid 20% tax on a relief at source pension scheme. So self-assessment, but for net pay arrangement, salary sacrifice, there isn't anything further to claim. It's already taken care of in the contribution calculation.
Super. Now, the next one isn't a question, but I'm going to give it a bit of a shout out because everyone is welcome. We've got 171 joining us today, and we've got someone joining us today from Boston, Massachusetts, who says we're expanding into the UK. It's my first time on PQT. Really excited to learn about UK payroll. Well, Cynthia, you're in the right place. If you have any questions, this is the place to put them in. Let us know, and best of luck setting up that UK payroll from Boston. And lovely to have you here. Right, next question. Is there a cutoff on registering for payroll benefits, and how do we do it if Government Gateway link doesn't work? Let's go, Matthew. 5th of April.
Yeah. 5th of April, so you can do it right up to the start of the new tax year. So 5th of April, you've got to do it. If the Government Gateway link doesn't work, I'm not sure what to do. I think try again another time, but probably give them a ring. I'm not sure they can do it over the phone. Simon might be able to answer that.
Yeah, I don't believe so, but if you've got a kind agent that you know, they can potentially do it for you. These days, you didn't used to be able to. In prior years, only the employer could register. But if you've got someone who's got an agent account, they can potentially do that registration on your behalf. It's just a thought. Who those people are, don't know. You always ping me a message.
Yeah, it has to be Gateway, because when you do go through the process, as Matthew quite rightly said, you get a list of the benefits, and it's actually the same order as the P11D, so basically A to N, but then it will then show the staff under that PAYE scheme, and you have to pick them. So in principle, that's not something you can shut dogs. It's not something that's not something you can do over the phone.
Yes.
They say as well, by the way, that it's a same day return or same day alteration to the coding to the day that you say that you request it. I'd probably not be that, I guess, carefree. So waiting till the 5th of April, I would possibly be doing it a little bit earlier to ensure that those codings have actually been done.
Yeah, so I was thinking, just clarifying on that, Nick, a little bit. When you report on P11D, you get that double hit in the second year of tax collection because they'll collect the year that they didn't know about in the current year. And I guess that's what we talk about a little bit when we talk about the doubled hit of PBIK. But PBIK, there isn't really. The double hit is just making sure that transition occurs. But if in first year, if you're P11D and then your PBIK, you may get that same effect. But that's only because HMRC didn't know about it before. When you register, when you first report on P11D benefits, they then adjust everyone's tax code in future years to take the collection of the tax of those benefits. So they don't wait for the P11D, they take it up front. By registering, it removes that upfront hit. And if you leave it to the 5th and you're paying early in April, it's probably too tight for the benefit amounts to have been removed from the tax coding. And those tax codings, generally, I guess just as general information, the new year P9 tax codes start to be issued in effect next week, so in February. If it's not next week, it's the week after. So they don't issue them on the 5th. Yes.
Amazing.
So
well,
very
I think
soon.
Next couple of questions actually relate to some of those responses. So let me just run through those. And I thank you for those. I've still got questions coming in, which is fabulous. Keep them coming. This is your show. So we will get to them. Don't worry. Stay patient. Stay online. We'll get to every single question here. So next one. Will employees be impacted by the PBIKs in terms of tax deductions? Tax codes normally change around August for the previous year based on P11D submissions, and then we will be submitting additional benefits within that same period. I think it's similar to what you were just discussing. I don't know if there's anything you need to add to that point, or have we covered that?
Yeah, but payrolling itself, I'd suggest, doesn't really cause the hit. It's the delay in P11D action. So for anybody starting out with payrolling, you're going to be paying the right tax amount when it's due, and you'll never get that double effect. But I think there's a transition point here. Usually that hits whether you're payrolling or P11D, those that have a benefit in the first year, HMRC don't currently know about it. In the old days, going back some time ago, quite often those P11Ds were not processed until January. So often you got hit for the prior year, the current year, and then you got assessed for the next, all in one go. It's been a little bit better because P11Ds have been electronic only for the past 2 years. So you're getting probably a July, August, sometimes a September change point. There is always that element of a prior year collection may take place, but that would be due anyway. Eventually it'll eradicate it. So my suggestion is it's no worse than the current P11D catch up.
So another question we've had in from Carrie, and Richard Bobby's take this on. Will we still then have to do the P11D B in brackets when payrolling benefits become mandatory?
No. Yeah, I think as Richard's probably shaking his head there, P11DB will apply to the 25-26 tax year. So that's the return that you have to do in July 26, but it won't apply to the return in July 27 because Class 1A is becoming a real-time calculation.
Just to sort of add,
I'll slightly adjust it. I think there will still possibly, is there still going to be a P11DB for the phased items though?
There may be.
Correct.
Yes, for accommodation.
That's what I was going to jump in and say. So from April 26, if you want to voluntarily payroll the loans and accommodation, you would still have to register for those, and then they would require a P11DB. But I believe we will be getting an amended P11DB that will just show those items. So it'll be a much smaller P11DB.
Super, and a thumbs up there from Simon as well. Next question, can you process cars through PBIKs?
Yeah, reluctantly, I'm going to say yes. And it's one of the areas that people find most confusing. So the card detail is fairly complex. There is actually a page on our SD Works guides on payhr.uk on payrolling cars, and it lists a little bit solutionized to us, but it follows exactly the HMRC pattern of data requirements. But if you payroll cars, there are three aspects. Often they're done via salary sacrifice. You need to take care of the salary sacrifice arrangement. If there is no salary sacrifice involved, or even if there is a car benefit charge. And a misnomer or a mistake I think many people have had over these past years is, of course, us being electric car owners, Nick, there is no company car charge for electric car. Oh yes, there is. It's currently 2%. And from April, it becomes 3%. So it's going up 50% from April, and it goes up to 4% the year after. So there is a company car charge on EV vehicles, even via salary sacrifice, but that's different than the sacrifice amount. So sacrifice you've got to take care of. Then you've got the company car benefit charge, and then you're required to report the car details via payroll as well on the FPS, something we've had in it came in from memory, I'm going to say from 2017, because it wasn't from the first year of payrolling. They had no medium for it, and they brought it in voluntarily, and then they made it compulsory in 2018. I'm saying that from memory. So
yeah,
the
it was to replicate the P46 car form as well, Simon.
Yes.
So obviously you don't need that if you're payrolling,
Correct.
because it's going through, as you say,
Yes.
the FPS.
Yeah, but just watch out. The values are different because you're predicting an annual collection, whereas the FPS is collecting real-time results. The FPS reporting the company car is informing HMRC what you think the total will be that you will collect through the life of the year. And of course, if they change car mid-year, you have to change that because it will be wrong.
So I think we've covered this, but because it's come in again a couple of times, and maybe the people joined us slightly late, we've got 173 on the show now. It just says, what's your experience of double taxing first year and the treatment by HMRC? Can we just clarify that one more time for the audience, just to make sure we've covered it off?
Sure. I don't think it occurs. That's an impact of P11D second year regardless. Others may have a view, but because if you register for payrolling, the benefit charge is removed from the tax code. Generally, you don't have a double charge. The double charge is in relation to whether HMRC knew about the benefit in a prior year and are doing a catch-up. That occurs whether you P11D or payroll. It's just my thought. The other guys may have a slightly different view.
Yeah, we did a bit of work on this, Simon, and there is a hit group, and it's those that joined within the last 3 months of a tax year.
Yes.
Were the biggest hit group. So the whole point of real-time coding is that you are coded in real time. And for the majority of people on benefit, the case will be that they won't be being double taxed. They are just being charged in real time for the ongoing benefit that they receive. The issue, however, is there is a group, and it is that sort of last 3 months of the year group where they join you, where there is a high likelihood that there will be a lag in relation to the coding that they have, where in principle, and this is, I guess, the question here, is it isn't any different by going to payrolling, because they'd have been paying that even if it wasn't being payrolled. So in the majority of cases, they would already have been double taxed. The difference now is they are seeing it in real time on the pay slip. So I think it's more the discomfort of the process rather than a change of process. But, you know, as an employer, as I mentioned earlier on, you've got to be considerate to them. And as I said, there are employers that are thinking about, rightly so, possibly giving them short-term bridging. It's really just support. But it's all then about the communication you have with the member of staff and wording it correctly so they appreciate that it isn't really a change per se to how it would have been. It's just the model now and the structure of it that's changing.
Yeah, Mathew, have you got something to add?
I just say absolutely agree with what Richard and Simon have said, and my personal sort of recommendation is exactly what Richard said at the end there. Be really careful with the wording. I really do encourage people to try and call it something like overlapping taxation, or to really keep them distinct in terms of they are taxation for different things, rather than saying double taxation. I know it's a very easy trap to fall into because you're being taxed twice for something, but they are distinct, and being strict with yourself in how you name it should help you to explain that adequately to employees who are definitely not as up to speed with all this as you will be. So if you can help them understand that, it's going to help you and get less queries through. So just bear that in mind.
Thank you for everyone who's putting these questions in. I know some of you have been waiting sort of 20 minutes. We haven't got to your question yet, but rest assured, I will get through them. We knew this would be an interesting subject area. And, you know, if you've got a question, you put it in the box, there's a chance that someone else on this webinar is thinking or has the same problem as you. So thank you for your patience. Let's get through it. I've got a really interesting question coming up, actually, which I have my own personal interest in its response. Before we get there, though, an observation comes in saying, sadly, some of our employees are getting the tax code changes now for BICs from 23-24 tax year. I'm surprised they are so far behind. And Graham came in and said, I agree with Simon, I agree with Richard, and I agree with Matthew. So some observations there as well in that last response. Thank you, Graham, for that. Right, quite an interesting question. Are there any updates regarding directors only receiving minimum level of earnings to count as qualifying year for pensions for having high level benefits such as car, PMI, etc., because there won't be enough to cover the tax due? Let me come to Matthew for this one. I think it's a nice question to come into the CIPP anyway. What would be your response?
So at the moment, the answer is no, we don't have any of that information. To be brutally honest, we have had a lack of information totally, to be honest, about how some of these things are going to be properly enacted. So I think we're waiting on further information from HMRC. We've spoken to them specifically about things like the 50% tax, which is what is going to be causing issues with directors, etc. So they understand that there's a need for better guidance in that area. They said that will be forthcoming, but really we are waiting now for much more information from HMRC.
And I think you can take this question into so many different areas, because another one could be, what happens if a lady goes on maternity halfway through the year? So adding that all into one sort of umbrella with the 50% limit, there were two optional sort of views that were being reviewed. The first being that you will carry it forward until you do have income to take the tax from. The second option, which would also be the case, because then you could ask the question, well, what happens if you never have enough income in the year to take the money from? And that then makes it a situation where you're reverting to the P800 process. So it won't be your problem. It'll be HMRC's problem to claim the uncollected tax from the individual. Now, with a director, you would suspect that they would be self-assessing anyway, so the pickup would happen there. But for whatever her name is on maternity, it would be a P800 request from HMRC to recoup the unspent taxes. But again, we're in a position of correspondence and communication that the member of staff will need to know that there is uncollected tax, because what you don't want is to get to sort of, you know, the end of the year and have people basically smashing your door down on the grounds that they've had a P800 that they weren't expecting and they can't afford and they haven't got the money for it. So it's all about planning prep. You'll know that they've underpaid tax because you'll have a carry forward, and it's just ensuring that that's really strongly communicated, because it's going to happen. It's undoubtable.
And I'm thinking that most software actually shows the unpaid tax amount on the statutory limit, 50%. It should appear on the payslip and also unpaid tax, and it will show you a value. But I think what we're saying here is there is a statutory limit, so you can only take 50% of cash pay. So when you payroll these items, they're usually non-payable and marked with a BIK marker, which is reported on the RTI submission, showing its benefit. So because you don't want to impact their universal credit claims, so it's not treated as cash pay. But the 50% limit of taxation doesn't apply to the BIK, it applies to cash earnings. So you may have unpaid amounts, but what's the result? Well, the result is those collections, I mean, we don't know the detail, Matthew, and we've spent lots of time talking with the people as well, because I think they're thinking they're going to get this real time. The reality is at the moment, as I see it, they'll operate exactly the same way as P11D. You'll get a tax bill to pay the bits that haven't been able to be collected. But that's what happens today.
Well, interesting. Some observations from the person that posed in the question to Villa, and she said, I like that approach, Richard. The key for payroll should be report accurately in real time. Then it's between HMRC and the EE, but it's always payroll got it wrong when it comes to it. And in relation to what you said, Simon, said not all payrolls, it needs to be covered by HMRC or system requirements. So, you know, it's a great question, by the way, and I think thank you for putting it in there, because it's challenged our panel, and it's obviously people are enjoying this. Our attendees have gone up by 10 as we've opened up this subject. Almost 180 of you now watching. So if anyone is new to the show, if you have a question around PBIK you want us answering, or about anything in payroll, do put it in the questions box. Well, let's run through some of these. We are starting to work through them now, which is great. Thank you for your patience. Next question: if the weekly worker has 2 jobs and applies for SPP for 2 continuous weeks in one of them, can he work in the second company as normal or use his holidays?
Shall I jump in on that one?
Yeah,
Yeah,
you
you had a
can
couple of
answer
nods.
the
Coming to you
question,
for it.
so
Well, I'm going to say,
it's my excuse.
if the jobs pre-exist, then yes. If the job doesn't pre-exist, in other words, they've taken SPP to go and start another job, then I don't think they qualify for the SPP. Now, I'm putting in maternity interpretation on that. So Matthew and Richard may come in and say that's not the case for paternity. But in effect, pre-existing arrangements, they could actually have statutory paternity from both jobs for those 2 weeks if they
Yeah, as long
pre-exist.
as they've got the 26-week service.
Yes.
Yeah, because that would be
Yeah.
usually the kicker, is how long have they been in the job? Because paternity still has that.
I have a
limit.
feeling that the second job starting during the period of leave
That you've
applies to
stopped.
maternity.
Yes.
I'm not sure if that applies to paternity. Obviously, there's a lot of things that apply to maternity, alabaster, etc., that don't apply to other parental leave. So I would need to check that. But you know, the basic answer is, as long as you qualify at the start for both positions, then that should be fine.
Yeah, they're
It's really
independent
the
of
same with
each
all
other.
parentals, Nick. You can, you know, if you're pregnant, you've got 2 jobs, and you qualify in both because of
You
your
get
level
2.
of earnings and level of time with them.
Yeah.
So be
Yeah.
it. So
Absolutely.
But what some people sometimes think is that they can therefore end their maternity. Well, no, they can carry on with their S&P and take on another job instead.
no, that's
The
very
problem is
different.
when you do that, your maternity ends for them all.
Sure.
Absolutely.
Sure.
As
It has
Simon
to be
said, it's got to
pre-existing.
be a legacy role that you are fulfilling.
Yeah, good to make that clarification. Excellent. A little bit of an observation here. We've been payrolling for clients for many years. The biggest change for them is the Class 1A, which will need to be paid through the payroll. So we need to manage cash flow. Okay, question in from Sarah. How do we record the BIK tax for a late leaver notification, i.e. someone left on the 18th of June, but we weren't notified until the 5th of July?
Yeah.
Richard,
I'll jump in.
or get
Yeah, I'll
jump
go
in.
for it. It's
Both of
well,
you are
it'll be
nodding.
a adjusted FBS, like any other payment after leaving. The real key with benefits where possible and where necessary is ensuring that the pro-rated benefit cost to the day they leave has been calculated and shown before the P45 is issued. That is the key here. However, there is always going to be a scenario possibly where you don't know about it, because obviously all benefit providers are really quick in giving you all the information you need. That was my bit of sarcasm for today. So that could happen. So yes, it'll be an additional FES that would need to be fulfilled and sent to HMRC as it would for any form of adjustment after the P45 is issued.
Okay.
Exactly. So the next regular FPS submission would be fine, or a later FPS submission in that tax year, correcting the year-to-date value applicable will do it.
Okay, super. Next question, I'll come to you then, Matthew. You're waiting patiently over there to my left, so one for you. Salary sacrifice, pension and pay in lieu of notice because of redundancy. Can pay in lieu of notice be put into a salary sacrifice pension scheme when an employee is made redundant so they don't pay tax on it? Employers have been asking, and it's been suggested that they can't due to PENP rules, and I just wondered why not.
Very good question. I'm going to rely heavily on the legal disclaimer at the start. I don't think you can. I'm going to agree with the advice they've given. I don't think you can sacrifice it in because it's pay in lieu, not pay. But I would have to take that away and have a look. I mean, if Richard or Simon has any contradicting information to give, I welcome them to give it.
I'll put something in the fire rather than it being a sacrifice, an AVC.
Yes. Well, exactly. There's two elements to this, Nick. I think the answer is it can. Yes, as long as it's unless it's a decision after the fact that it's available for them. So the PEMP value would be subject to tax and NI. Could they salary sacrifice that? So don't get the pile-on, but they get an employer contribution instead, if that's contractually arranged. Yes, that's my suggestion. And as Richard's suggesting, if it was subject to tax, you can make a employee pension contribution which give tax relief, but it wouldn't give national insurance relief necessarily.
I believe we might have had a similar question like this through to our advisory service, and I hope I'm not speaking out of turn. I believe we came to the conclusion that because you could not contractually sacrifice that amount prior to knowing the amount, that's why you wouldn't be able to sacrifice that into as a sort of payment after leaving.
It's proactively sacrificed your income in return for the benefits.
Right.
So as you say, it could not be done retrospectively.
No, but it could be done before the amount's due for payment. So it's when the amount becomes available for the use of the individual, as long as it occurs before that point. Sometimes it's an element of thinking, can I sacrifice a value of a bonus, for example, that I'm going to receive in July? Well, it's not due for payment until July. You can sacrifice as long as you've done that choice before it was available.
Okay, that's great question as well. I hope that helps you, Carrie. Next question. I'll go in and come back to you then, maybe for this one, Richard. We have been payrolling benefits starting 2024 April, current tax year. When we submitted P11D for 23-24 in August 24, HMRC should have adjusted the tax codes in September or October 24, but they haven't. Do we still expect HMRC to send us the corrected tax codes before the end of the tax year? How long is HMRC? No one knows. I'm guessing it's a response. I'm not the expert here, so I'll ask Richard to come back with a response.
In principle, yes, absolutely. But if we sort of wind this conversation back about 10 minutes, you may remember a certain Mr. Parsons saying that in days gone by, it could be as late as January before they managed to implement or adjust the thing. It's got a lot better, but it can still be January.
Yes.
So really, I think it's one of those things you've got to keep your eye on as you get close to the end of the tax year, because it could be an application way later than when you do them. So,
what I like about this is if you don't work in payroll, no one else would laugh at that question, right? If you work in payroll, everyone immediately starts laughing. It's such an inside industry joke. Anyway, moving on. Thank you, Pramod, for the question. Next one comes in from Jackie. PBIKs, if we have visa renewals for employees residing in the UK late in the tax year, what will happen if we are unable to cover all of the tax due? Will this carry forward to the next tax year? Simon, I'll come to you with that one.
I'm trying to understand the circumstance there, Nick. Did you say visa
If we
application.
have visa renewals for employees
With
residing
visa
in the
renewals.
UK late in the tax year, what will happen if we're unable to recover all the tax due? It sounds to me that maybe if they were to go...
Yes, my initial reaction, I'll leave it to the others too, but I'm not sure that visa renewals are a benefit in kind that require taxation. That's my initial reaction. But you know otherwise, Richard, I can't see that visa renewals is a benefit.
No, not if it's required for the role.
No. Matthew?
I maybe read it slightly differently. I was probably thinking, aside from the visa renewals, if they've got tax to recover and the individual that's perhaps unable to get the renewal has to go back to their country, unable to reside in the UK, and there's tax due, how do you recover it? That's how I read it. I could be incorrect.
Yeah. Well, on that basis, you report the benefit value on the FPS without the tax recovered, and then it becomes an HMRC activity to collect any underpaid tax.
Okay.
In
Well,
the
maybe
same way
it's
as
one or the other.
800, because at the moment they could have been back for 9 months in their country, yet you reported a P11D in the July. HMRC, first they know, they'll start recovering it. They may never got the money, I guess is a challenge there, but that's a challenge now. Yeah.
Well, funny enough, and going back to the previous question, someone's come in saying they've just sent us our tax code changes now. Maybe they're watching this webinar. Maybe they've been inspired to send them out to you. You've got HMRC people watching, and you're going to, everyone listening is going to get their tax code changes.
It's like the old days,
isn't it? But it's also saying the irony is the HMRC are late sending us the tax codes, but they fine us if we're late doing it the other way around. I know, and it's...
Well, the oddity about that one, Nick, is quite often you would get a tax code issued on the 20th of March, and because you hadn't applied it to the March payroll, which ran 3 days before, they'd applied determination 80 on the employer for failure to collect the tax, which was impossible. But years ago, they used to have a tax code blackout period. It used to be about the second week in February, so it stopped. But when RTI came in, they will issue a code on the 30th of March expecting you to apply it in March, which is odd. I think they've grown up a bit to the extent of not expecting you to actually apply it, but they still occur.
Okay, good. We're almost through these. We've got still lots to get through in PQC today. Thank you, everyone, for all this participation. I'm going to come back to you in just a moment because we're going to go to a poll relatively soon. Still a few more of these to get through, though. The question comes in here from Jackie. It says, let's have a go. No, sorry, from Rebecca. If I have a benefit in tax year 1 via P11D, then in tax year 2, my benefits are still not payrolled, HMRC adjust my tax code to account for my benefits in tax year 1 and the expected benefits in tax year 2. Thumbs up.
They do.
Yeah.
That is correct. And so that's why I suggested actually moving to payroll makes absolutely no difference, really.
An observation, I won't give the software provider away because I'm not sure if I should. I'm just going to read what this out says here. I think software provider continues to add
somebody I know
continues to add the BIC during LOA, so it is included in taxable pay, and we allow tax refunds during unpaid LOA. So the likely problem is relatively small. So I think it's a bit of an observation, really, rather than anything else. Yeah. Beata says, thank you very much for answering her question. We're almost there now, guys. We're really there. We have employees that will qualify for SMP brackets EWC's 11th of May 2025. However, the individual is leaving the company voluntarily in March. We understand we are still obliged to pay her the SMP. We intend to do this as a lump sum in her final pay. Should we use the current tax year rate of SMP or the rate for 25-26? Simon's laughing. I'll come to you, Simon.
Yes. Well, you need to pay the rate applicable for the leave periods that fall. So for sometimes when you do that, you won't know what that rate is because it's not announced until November or December. So if you're paying a lump sum, you may not know, in which case when you do know, you need to do the top up to recover it. And you can still recover your monies, but for the weeks that fall in the old, you pay the old rate. For the weeks that fall in the new, you pay the new rate. Can you pay those up front as a lump sum? You can.
Yeah, can I add to that, please? Number one, it has to be an agreement with the individual to pay the lump sum. You can't demand it. Number two, we're back in my world of correspondence and communication again. Yeah. The net effect of the bulk SMP payment on the individual can be quite big. Number one, national insurance liability. By paying in bulk, you're paying all the national insurance in one period, which means only one primary threshold. Number one. Number two, have they got a student loan? Because remember, student loan will look at all nickable pay in a pay period. So the likelihood is you will massively escalate their student loan payment. Number three, universal credit. Universal credit is calculated and based on a period of time where pay is received. If all of a sudden you multiply their normal pay by about 6 or 7, it's going to have an enormous effect on universal credit. Now, they may be fairly happy with this. They may not have universal credit or student loans, but they must be made aware.
Super. If anyone watching this had any doubts about the credibility or expertise of our panel, there it was, summarised perfectly by Richard. Listen, we've had this slide in front of everyone for a long time. We've gone through an awful lot of questions. Thank you, everyone, for your participation with those questions. But let's move the conversation forward to holiday pay, where we are going to run our first poll as well in just a moment. We're going to talk a little bit about the understanding the variables and part years, which key sectors are impacted the most, and some common misunderstandings. So if we can move the slides along while we're waiting for that to happen. Simon, I wonder if you could give us a bit of overview on holiday pay and the common misunderstandings as well.
Yeah, sure. So I think the reason for highlighting this is because a lot of holiday years will start on the 1st of January. So they won't have qualified for the changes to the working time regulations, which came in on the 1st of January last year, but applied only for holiday years starting the 1st of April onwards. So now there's that cycle of a whole bunch more can apply a change to their rules, and that's in relation to variable hours workers or irregular hours workers and part-year workers. So in effect, you can operate what they call new holiday accrual or rolled up holiday. Some will say, hooray, the old 12.07% is back. It is different, quite different, because the old 12.07% tended to be based only on contract or base pay, whereas this, within the protections, it applies to all pay and all hours worked, including overtime or extras or training, etc., the 12.07%, or it could be higher because that's a minimum. That will apply, and there are added protections for those who are on sickness and on statutory leave, such as the things we talked about, SPP, SMP, SAP, SHPP, whatever. There are protections that you have to make those payments equally or an average basis during those periods of leave or if they're sick, which may seem a bit odd for a 0 hours worker, because a 0 hours worker may not be due or scheduled to do any work. They go off sick, they may have an entitlement to have an accrual for holiday or a rolled up holiday pay. Now, I think what this is illustrating here is that there are 3, therefore, holiday calculation methods that can be operated. For those that are regular, irregular, or part year, you can do the 52-week average. However, employers may choose for those who are regular and part year to do rolled up holiday or accrual basis, but only the regular contracted employees you can't apply those methods for. It's still 52 weeks average earnings. Those are my initial thoughts. So it's an element of, if you've changed year, you had the opportunity to change if you had 0 hours or irregular hours or part-year workers. A part-year worker isn't someone who starts and leaves mid-year. They have to have had a period where they're under contract but not paid.
Yeah, obviously the biggest effects realistically is education, as you'd imagine, because it's term time working, which is classified. But I think a lot of people haven't quite realised what part-year working could properly represent. So if you think about what it actually means, it is somebody who is on a contract through the year with the employer, but doesn't work every week of the year and therefore is not paid for every week of the year. So it isn't just term time. I'll give you an example. I used to work for a coffee brand, That coffee brand employed a huge number of students. Those students could well be at a university away from where they live, and therefore, when they were at university, they worked within the coffee shop. The problem was, therefore, however, that during Christmas, Easter, and other holidays, they'd go home and therefore not work at the coffee shop during those periods of time. The coffee shop know they're coming back, and therefore they don't take them off the payroll. So they are on the payroll for the year, they are contracted for the year, but there are weeks in the year where they're not working in the coffee shop or being paid for. So even though it's a very different scenario to term time working, it's the same situation. So I think the net effect is on probably quite a lot more people than people might initially consider. I think it's probably where I'm going with that one.
Yeah, I think it highlights as well some of the different sectors that are impacted the most. Anything you'd wanted to add to that, Matthew?
Just a clarification of the way that the regulations are worded did initially cause us a little bit of confusion. As Simon said, you've got someone who's contracted for the full year and has periods of at least 1 week where they are not expected to work and they will not be paid. Now, initially, there were some people that said, actually, does this exclude term time workers if you spread their pay across 12 months? HMRC did come out and clarify as part of the guidance that even though you may have spread the pay across 12 months equally, that pay does not relate to those months equally, and therefore the weeks that they don't work, they are still not paid for as far as HMRC is concerned. So it does still cover those term time workers. It would have been strange if it didn't, seeing as it was all based off the back of Harper versus Brazel, which specifically was a music teacher. But just to clarify that.
Super. Okay, well, let's get our audience involved. Let's run our first poll of today. The first poll, so a chance for everyone to have some feedback. We had a couple of questions come in as well, so I'll run through those as we run through the poll. The poll today is, are you changing to new holiday methods? For those in audio, 4 options here. Yes, we have irregular workers. No, we don't have irregular workers. No, not changing our approach. And yes, already using new methods. Now we've got a huge number of you joining us today, 173 of you. So if you get all of you responding to this poll, that would be fantastic. And while we're doing so, we've had 2 questions come in, which I'm going to pose, and we will obviously comment on the poll results as well in just a moment. First question is one that I can answer. Unfortunately, I missed the first 20 minutes due to computer updating. Can I get a recording of the webinar, please? Just remind everybody, you will get a copy of the recording, the slides, and a survey sent to you after the show. And of course, the episode is also going to be released on both video and audio formats on the Payroll Podcast. So you can follow it on the YouTube channel, Payroll Podcast, or on any of your favorite audio platforms. It's usually released about 5 to 6 days after today's recording. So whether you prefer to watch or listen, it will indeed be available. So please do subscribe to that. Little plug for the show that I run anyway, but also you get to hear our wonderful panel all over again. Second question, we have monthly paid colleagues, paid overtime, additional payments on top. We understand that we need to use a 52-week reference up to 104 weeks for holiday pay, but our employees can book holidays in hours. Do we calculate the average of additional pay for the last 52 weeks and then divide this by the current contractual hours to get an additional hourly rate to pay for holiday hours booked? A lot of the guidance talks about weeks, but typically employees don't book holidays in 4 weeks. Is there any alternative for monthly workers rather than taking into account the 52-week average? Obviously, they put a star in here, that's in relation to salaried workers. Simon, it's quite a complex question. Wonder if you could take that one on.
Yeah, the regulations are not very good in telling you what to do for a monthly. It is based on a weekly basis. Some of the newer regulations may cover principles on monthly. The other challenge, I just mentioned it, is strictly speaking, you're meant to include all earnings, whether you paid it or not, up to the prior Saturday to the leave in the calculation, which instantly we'll just throw our hands up in the air and say is actually impossible to do in the timeliness that you'd need to for the payment. So quite often many will take a pragmatic risk-based approach of taking the prior 52 weeks that it can recognise, which might be 12 months divided by 52. You could say there are more than 52 weeks in a year. well, that gives it an element of generosity, and use that on the extras only and pay that. Now, the comment in relation to hours, the problem with hours is you need to know what entitlement is being used, which equates to weeks, and that is even a requirement in the Department of Business and Trade recommendations. Is they don't care how you do it, except the holiday has to represent 5.6 weeks. So the best way for that is to have a fixed basis. So you could use the contract hours and do the averaging based on those contract hours, so that 1 hour represents, for example, if it was 35 hours a week, I think as you suggested, 1/35 of a week's entitlement used, you pay the extra. It's just a suggestion. Does that follow strictly with the regulations? No, but I think it's a pragmatic approach. Richard?
So while you've been speaking, I've been putting up a slide because I didn't want to say the wrong thing. But we were talking about this a couple of years ago. So this is bays. So if you are monthly paid, it's not quite as simple as looking at 12 months pay, because 12 months pay does not equal 52 weeks. Bay's statement was that employers should be calculating weeks' earnings by using the records of hours worked in each whole week. It may be necessary to use an average hourly rate to estimate a worker's rate of pay. So the calculation they have used was monthly pay divided by hours worked in the month to get an average hourly pay, and then average hourly pay multiplied by the hours worked in a week to get the weekly pay. And that was Bayes' thing.
Yeah.
So if it wasn't confusing enough.
Correct. Do you know any system that does that, Richard?
Sorry?
Do you know anything that does that?
No. Yes, the pen and a calculator.
Yes. So the same basis as if you want to identify hours in the week is to, yes. So there is an element of coming up with weekly values on that basis. So there is a pragmatic choice of what do you do. But Richard's quite correct. But the methods that people suggest often on these fluctuating hours don't work or align with that Bayes, which is now DBT guidance.
Okay, well, we've got a couple of other questions. Well, I'll go to those in just a moment. Let's have a look at these poll results. Thank you for the 81% of you that voted. Hugely appreciated. Let's have a see the results. We've got 13% say yes, we have irregular workers. 48% say no, we don't have irregular workers. 25% said no, not changing our approach. And 15% said yes, already using new methods. Any comments on those results very briefly, Simon?
Yeah, it's interesting. I think that's fairly representative because I think most employers don't actually have that many irregular or part-year workers, and I imagine that there isn't a requirement to change. So yeah, that's interesting. But that's almost 50% there, Nick, that don't have them. So they would have to. They're stuck on the current method, and I imagine a lot of those are probably monthly paid as well. So only 13% have irregular workers. Strange that we've got 13 and 15, but then this is a selection, isn't it? I guess we're saying yes, we have them, but the others, so that's 28% then, isn't it? So some have it and some have it, and they're using the new methods. That's, I imagine most of those are April holiday year starters. Is just a thought, but interesting. It's not a question we asked. It would have been interesting to see if many had implemented in January.
Well, next time we'll have a second poll. Yeah. So let's just go through these other questions and we'll jump into the next part of today's show. We have a question that says, what is the threshold for irregular workers? For example, if we have an employee who works 51 weeks of the year, had 1 week without any hours whatsoever, are they considered irregular? Mathew?
So yes, I suppose it depends on the structure of why they're not working and what that is. If it was, for example, forced annual leave, that would not count because that is not a week in which they are not expected to work and they will not be paid because they are then essentially being paid. But yes, the definitions do state a period of at least a week, purely because that is the smallest payroll reference period allowable in law. And as long as you fulfill that criteria of having 1 week not paid, not worked and not paid, then yes, they could qualify as an irregular hours worker. Now, one thing that we kind of didn't mention, or we might have just briefly touched on, is that it is the employer's choice as to what calculation method to use. An employee can't ask for, well, they can ask, but you don't have to give them a rolled up holiday pay or to use that alternative irregular hours accrual. So it's still up to you what calculation you use.
Fantastic. I've got a question here. I think it's a question. Do you also have to disregard months and weeks which have adjustments in them? That might be related to a previous question.
Yeah, it depends on the interpretation of the regulations. In regards to some of the regulations, it says you exclude 0 weeks, but in some of the other regulations, it talks about normal weeks. And there could be things in the middle. So some holiday schemes, for example, construction, will have you ignore a week where there's any sickness. I'm not sure that DBT would contradict or say that that's wrong, but others wouldn't, because with, for example, a 0 hours worker, if they work 1 hour or they work 50 hours, what's not normal about them? Because that's what you're generally doing. So, and also there's an element of thinking, even on the construction, it seems a little confusing because sometimes you think they've done, I don't know, 60 hours from Monday to Friday doing all the extra work, then they take Friday off sick. Would you exclude that week? Because their earnings might actually be higher that week than normally. So would have enhanced their holiday. It's going to be a pragmatic or risk-based judgment by the employer what's included. Strictness of the guidance from the DBT or BAYS that Richard referred to earlier is that 0 weeks don't count.
I think going on to your sickness one, they also state that if they are sick for part of a week, that you only include the non-sick part of that week in that week as part of the calculation. And as you say, that can obviously flex it up and down, more likely down than up. So if they're off sick for 4 days out of 5, so they only get paid 1 day's pay that week, that's the pay week as far as the rule is concerned for the calculation. And therefore it could be obviously 1/5 of what that week could normally be. So it is definitely a swings and roundabouts scenario.
We've had a couple of questions come in actually about SSP, so we're going to hold those. We've got a section on SSP coming up, but please keep the questions coming in now, so when we get to that section we can bring them all to the table. Sorry, Matthew, you had something to add?
We're just going to add, we always get questions on what week should and shouldn't be included, and the thing I always try and get people to remember is that the regulations tell you a minimum that must be paid, not necessarily what must be paid. You are always free to go above and beyond that. So if your risk-based approach is to be risk averse, you are more than welcome to exclude weeks that would lower the entitlement in order to increase the entitlement and make sure that you're hitting those minimums rather than potentially falling foul. So you're always free to go above and beyond what the regulations state, but that's completely up to you.
Yes, and that's an interesting comment that Matthew's made, and it's just a reminder, because sometimes we think the regulations are convoluted and confused, therefore I'll do what I like. To an extent, DBT allows you to do what you like, as long as it's at or above the minimum. So your do what you like can't be less than the minimum. It has to be at or above.
Super. Well, we seem to have lost Richard for a moment. Either his dog has attacked him and taken over and we'll come back, dog in his chair, or he's lost a bit of internet signal. So we'll wait and see. Let's move on to the next section, employment allowance. And straight after that, we're coming into statutory sick pay. So thank you for your SSP questions. I haven't forgotten them. If you're wondering when I'm going to ask it, I'm just delaying it slightly till we get to that section of the show. So employment allowances, everyone can have it. Small business rules don't apply, but there are some challenges for companies. What's the impact, Simon?
Okay, so yes, so the Chancellor announced an increase to the employment allowance from £5,000 currently to £10,500 from 6th of April 2025. Previously, you could only have it if your NI bill that related to the test was under £100,000. And some years ago, you'll remember we had all these European rules as well on subsidies. Now it's available to everywhere. A lot of that goes to one side. So pretty much all employers are entitled to the employment allowance. The challenge area is there's only one allowance allowed per organisation or family of companies. So if you're part of a multi-PAYE scheme company with subsidiaries that are linked, that allowance only applies to one PAYE scheme, not all of them. And that's the element of confusion or difficulty, is deciding what. Also, for a number of years, the employment allowance used to be a once-off signal. So you would claim it and it would last forever. Nowadays, you don't. For the past, I'm going to say 3, 4, 5, it may even be longer, you actually have to restate your entitlement to it annually on the EPS or employment payment summary submission that you're entitled to it. So yeah, number of impacts. It's meant to be offset some of the 15% rise of employers' national insurance, well, the 2 percentage point or 1.2 percentage point rise from 13.8 to 15%, which I think worked out at about a 6.7% rise from memory. It's to offset some of that expense, certainly for smaller employers altogether, so they don't get impacted.
Has the state de minimis been removed?
I think it's not applicable. Go on, Richard.
No, I was going to say, I didn't hear your question, Nick.
Yes. Has the de minimis limits been
well
removed?
here? But what we're seeing, obviously, a lot of larger employers, it is actually quite easy to recognise and understand the connection, because it's the same rule as it is for the apprenticeship levy allowance. So if you are claiming your 12,500 quid, whatever it is at the moment, apprenticeship allowance, the same connection rules would apply. So hopefully you would work in the same format you do the other one. The other key difference is it can be claimed at any point in the year now, which is obviously for a huge number of businesses new news, because they're not an SME, but you don't have to claim it in April. It is when you request it on your EPS that it is applied. So a lot of businesses, especially smaller businesses, have been quite strategic when they have been getting the £5,000 historically, that they will look for a high cost month and apply it then. So obviously it negates the higher cost months within your year. But yeah, sorry.
No, super. Did we answer the other question, Simon? Did I answer that? Do we need to rerun it? Has the de minimis been removed? Has the state? Yes. Yes.
Yeah. Well, Matthew, I'm going to say, from my view, I don't think it applies because it's generalist benefit to all. The de minimis state aid usually applied because it was for selected industry types, and I think now the application of the new rule, it's fallen away. But
yeah,
but I'll leave it to the experts.
Simon.
Yeah,
de minimis has gone, isn't included.
Yes.
Yeah, I don't think they explicitly stated anything in any of the sort of guidance that they've updated, but yeah, I would assume so.
Okay, super. We've had one more question as well before we move into statutory sick pay. If we buy a company in a tax year and they have taken the employment allowance, and so have we, what happens then? Would they have to pay it back to HMRC, or can they keep it and we ensure only one legal entity only takes it from the new tax year?
Yeah, the latter. So yes, they can keep it because that was established. The right, although Richard's indicating you can indicate your right at any point during the tax year, the establishment is at formation or the beginning of the year, 6th of April. And if that judgment point, you were entitled to it, that entitlement remains to the end of the tax year, whether there's takeover, merge or anything. But when the new tax year comes in, you would no longer be entitled for that new judgment point because you're now linked or part of a group. So yeah, you could take over lots of companies in one year all of them could be entitled to the employment allowance. It continues until the 5th of April. Then in the new year, 6th of April, it wouldn't.
Super. I'm going to move the conversation along now because I do want to get to statutory sick pay and a few other elements of today's show. We've already put us to the last 15 minutes. So let's go to statutory sick pay. We want to prepare everyone for the 2026 changes. There's a few things here to run through. Before we jump into the overview, though, I promise I'll come back to this question. It relates to SSP and redundancy. So if an employee has been on SSP for, say, 2 months and is now being made redundant, how should their AWE be calculated, bearing in mind they only earned SSP for the last 2 months?
Well, Nick, my initial reaction is that that would link. So there isn't another AWE calculation. So because it's not, unless 56 days have elapsed on the between the previous sickness, and it doesn't sound to me as if it is. It's just a change of status. So the AWE calculation was established in the first PIW that was linked to it. So it's already there. Or have I misunderstood the question? And I'm probably looking to Richard and Mathew on what they understand.
But it's within 8 weeks, all the work's already happened, and it has to be the same, even if it isn't. If that makes sense. So if they had an AWE and a calculation done during the first period, they come back to work and change their hours, change their pay, whatever. It makes no difference because of the link. You still use the rules applied to the first linked sickness. So,
hey, good. Mathew, I'm going to come to you to give us a bit of an overview here. You're always very good at articulating complex rate changes. So I wonder if you can give us a bit of an overview of the 2026 SSP changes, percentage rate analysis, and a little bit more information about the LEL limits as well.
Yeah, so currently we are waiting on government response to a consultation to strengthen statutory sick pay. And the key elements of that is that they want to get rid of the lower earnings limits that everyone qualifies for statutory sick pay, as well as get rid of the waiting days, so everyone will qualify for statutory sick pay from the first day of their sickness. Now, as part of the consultation, they want to essentially decide on a percentage rate that statutory sick pay should be paid for those low earners, because the government doesn't feel that it is right to put the burden on employers to pay more than someone would have been earning should they have been working. Now, within that consultation, they gave some estimates between 60 and 80%. Now, we have been assured that that is not indicative of government intention. That was just to demonstrate for the purposes of the consultation. However, we won't know if that's truth or whether they actually do intend to do between 60 and 80% until we get that consultation response. As you can see on the slide here, there's a little graph to sort of show where people will be, what their earnings will be on those different percentages if they earn less than the lower earnings limit. So as you can see, there is a small group of people potentially that will have their entitlement reduced should they introduce this percentage. Now, this is something that some people aren't too happy about. There is a safer sick pay campaign, which the CIPP has supported, looking at a different way in which to calculate this. As I said, we haven't had that consultation response just yet, so we don't know what the government does intend to do. But just to sort of ease everyone's mind, as it says on the slide, we do expect these changes for 2026, not 2025. So this isn't something you're going to have to worry about for this tax year, just something to keep our eye on for the future.
Okay, super. Anything else? This is something we need to add. I would like to take the section of the show now to the latest news. We had some relatively breaking news that's coming, I think, this week. Simon, we talked about it briefly offline, so apologies this wasn't in the what we were going to be discussing start of the show. But we know the hours collection 2026 has been cancelled and statutory payment recovery has gone up. So Simon, I wonder if you can just give us a bit of an overview of that, those latest updates. And while we do that, I'm going to run a poll at the same time. So keep your hands back on the buzzers, and what do you think the percentage should be in relation to what we've just been discussing? Should it be 0%, 50%, 60%, 70%, or 80%? And while I'm collating those results from this poll, Simon, can you please give us an update on the latest news?
Yeah, sure. I'll cover the recovery one because it kind of relates to SSP, but it doesn't.
Sure.
But other statutory payments, so for statutory maternity pay, adoption, and all the other parental leave payments, a late breaking announcement on Tuesday that the current compensation rate for small employers of 3% is to be increased to 8.5% from April 2025. The software developers are probably a bit upset about that because they'll have cut all their software and built it, and why this wasn't announced before. And it is implied there's been an HM Treasury consultation. However, some will probably say, what consultation was that then? But just to confirm, those of you that are small employers with a NIC bill under £45,000, if you have someone go on maternity leave, you can reclaim 100% plus 8.5% compensation for those payments made from the 6th of April. On that lump sum question earlier, we would probably say, well, leave it, if you're a small employer, leave the lump sum payment to the 6th of April and you can get 8.5% extra added, whereas if you pay it on the 5th, you'll only get 3%.
Very good. And there was a second piece of news as well, I believe you wanted to highlight.
Yes. Yeah. Well, the other news is in relation to hours reporting. There's been one that's been debated. Mathew and Richard probably have also been on similar panels to myself, and they'll know that I've been a bit of a thorn in the side on some of the stuff that's come along. And the repeated question to HMRC was, what do you need this value for? Repeatedly, and at one point there was going to be an obligation for an employer to have to choose one of about 20 reasons on their FPS, or just by selecting on a drop-down list. Yes, when you employ 240,000 people, I don't think so, of why you can't give their working hours on the FPS, and then you've got all the pensioners and everybody else that doesn't have working hours. So it's an element of what is this value for, and they never could really give a question. So it's some probably thinking of, oh, right, okay. So they've announced again on Tuesday, it was confirmed that they're not progressing the requirement because it was going to be mandatory for all employers to report the working hours on the FPS from April 26 as originally proposed.
Okay, super. Let's have a look at what these poll results look like then for everybody. And for those in audio only, we've got what do you think the percentage rate increase should be? We've got 17% say 0%, 14% say 50%, 12% at 60%. I'm going to swap around, it's a bit confusing with all these percentages. 15% at 70% and 42% at 80%. Let me come to your thoughts, Mathew, on those results.
Yeah, not surprising. I think one of the things we probably left off this poll was 90%, because when we went out to our members, I think we had some discussions, and quite a lot of people wanted to go with 90%. I think purely because it kind of aligns with some of the processes we already have within payroll of doing sort of 90% of average weekly earnings with maternity, for example. So that's something that our members have fed back, and that we obviously fed back through our consultations. So yeah, not surprising that people want it on the higher side. Statutory sick pay is obviously meant as an income protection for people while they are off sick, but obviously we do understand that that needs to be balanced with the extra cost burdens on businesses, which is why there are some people opting for those lower percentage rates as well.
Absolutely, and that's a really good overview. Right, I'm going to skip the next section on pensions. We haven't got Andy Nichols with us today for the moment, because I want to bring everyone who's watching this to the SD Worx Academy slide, because there is a new year discount. New year in block capitals 25 will give you 10% discount on some of the courses if you book before the 31st of January. It's the 30th today, so if you're live now and want to get involved in any of these courses, now is the time to get booked on. We've only got 5 minutes left of today's show, so I don't want you to miss out on this offer. The upcoming courses, we've got one running on the 31st of January, which is holiday pay, understanding entitlement, accrual, pay and rolled up. On the 12th of February, there's UK Payroll 1, which is all about income tax and national insurance. On the 13th of February, it's followed up by UK Payroll 2, starters and leavers, student loans and statutory payments. 14th of February, payrolling benefits in kind. I'm sure that will be another popular course. If you haven't, or you need more information after today's PQT, that's the one to sign up for. 21st of February, directors national insurance, and 19th of March, national minimum wage. Just remind everybody, I know it's on the slide in front of you, but if you are listening only at the moment, any course booked before the 31st of January, so before tomorrow, will receive 10% discount on some of those courses with the code New Year, all black capitals, and the number 25. Anything you want to add to those, Simon? I know you're heavily involved in some of these courses. It's not as yourself delivering, of course, but is there anything you want to bring to our audience's attention in the last couple of minutes? Now would be a great time to do so.
Yeah, sure. The popular subjects, I think we've covered some of them. PBIK, holiday are regular ones. There's also another one on the 14th of March, I think, in payrolling benefits in kind as well. You can see the schedule there, but these are the ones up and coming. Very popular on the payrolling. I think we've got around 30 registered attendees for this next event, and people asking about the next one, probably because of the news of 26. But it'd be great to see you all there, and look forward to. And Richard and his organisation will be busy, so will Mathew, on doing similar things.
Yeah, fantastic courses on offer from the Payroll Centre, CIPP, and of course SD Worx. So check out all three sites, and I'm sure you'll find whatever you need your team to develop in, or the course that's right for you across those three businesses. Now we are almost at the end of today's show. Just to remind everyone, if you were really excited by the pension section, we'll make sure we bring it into next month's PQT. We're going to talk about the drop pension reforms and their implications, the potential increases in employer contribution percentages, and how businesses can prepare for pension-related changes. So if you have any pension inquiries or questions, get them prepared for next PQT, which will be on Thursday, the 27th of February. You can sign up at sdworks.co.uk/PQT. It's going to be another fun packed show. Remember to fill in the surveys. Tell us what you want us to talk about. That pension section will be involved, but there'll be other subjects as well. And of course, we'll always be bringing you the latest news, the latest changes and developments that happen between now and then. I want to take this opportunity to give a huge thank you to our expert panel today, to Mathew, Simon, and to Richard. And most importantly, over 180 of you at one point joining today's show. Thank you, all of you, for all of your questions, all of your insights, all of your comments. We can't run this show without you. So thank you for attending today. You will be sent a copy of the slides. If you still need more information, look out for the Payroll podcast, where this show will be released once more in about 5 to 7 days' time. I've been your host. My name's Nick Day. Look forward to seeing you on the 27th of February for the next edition of PQT. Thanks, everybody.
Thank you very much.